Do you understand what's driving the economy and financial markets right now? In today's video, we'll go over the key macroeconomic forces currently affecting your life and your investments, from inflation and interest rates to jobs and corporate profits. And please, watch until the end of the video, where we'll show you if domestic and international stocks are currently overpriced or if their valuations suggest attractive buying opportunities. Welcome to Wealth Matters for Physicians, brought to you exclusively by Altfest Personal Wealth Management, the channel that provides physicians with key investing and personal financial planning strategies. For 40 years, physicians have turned to Altfest to help them plan financially to gain the financial security and future they deserve. We can do the same for you. My guest today is Ryan Graham. Ryan is a managing advisor at Altfest, where he advises clients on all aspects of their investment and personal financial planning lives. Well, Ryan, thank you very much for being with us today on Wealth Matters for Physicians.
Thank you, Mike. Happy to be here.
Great. Well, let's get right to it. Today, we're reviewing the macroeconomic forces that got us to where we are now in the third quarter of 2023 to help us understand what might lie ahead for the economy and the investment markets. So, Ryan, regarding inflation, where has it been? Where do we think it's going? And why should we really care about inflation?
I think a visual could be helpful here, Mike, just to give everyone a sense of where inflation has been and where it's going, like you said, and then I'll kind of get to why it's important. This chart that I'm sharing, you can see a relatively short history, I would say, of inflation. And you see last year, we had a pretty big peak. And I'm actually just going to zoom in a little bit on that part of the graph here. You can see that there was a pretty high peak last year in inflation. Core inflation, which is this oranger line here, was somewhere around the 6 to 7% range. And it's currently a little bit lower, right around 5%, but remaining a little bit sticky. Thankfully, we've seen a lot of things that are fueling inflation, like energy prices and food, coming down pretty meaningfully, which we can see by this purple line, which includes those items where we peaked at 9% last year. We've come down to 4%. It seems like maybe we're kind of flattening out. So inflation may have a little bit more room to come down, but maybe not a lot. We may not get to like that 2% or below 2% figures like in the past. So thankfully things are trending down, which in general is probably a good thing for the economy. And inflation, I would say, is rather important, obviously, to a lot of individuals, doctors, no matter who you are. You're impacted by inflation through things like going to the grocery store, for example. But on top of that, inflation is a key metric that the Federal Reserve looks at when setting interest rate policy. So it does have a very impactful, although sometimes indirect, impact on stock markets, bond markets, kind of what you're earning on your investments. So it's really important from a portfolio construction standpoint as well.
Great. Thank you very much. And, kind of not the same by any means, but related is when we're talking about inflation, often the talk goes to interest rates. So can you tell us what's been happening with interest rates and where do we think that they'll be going?
Absolutely. And I'll go ahead and show another visual. Interest rates, as you can see by this chart here, we've seen a very quick rise in interest rates, very quick, historically speaking. So starting, specifically throughout 2022, we saw a very quick rise in interest rates up to, let's just call it, close to like 5.5%. And this was very important because it had a major impact on stock and bond markets last year, both which were down very meaningfully. Going forward, we do see interest rates coming down, and that's something that the market believes, as well as the Federal Open Market Committee also believe that interest rates will be coming down over the next, say, 2 to 3 years. And you can see their targets here, which I'll just zoom in as well on. that we could be coming down from kind of like a 5.5% or so level down to more of like a 3 to 4% level in the next 2 years, which is certainly something we are considering as, you know, we advise the physicians we work with, as well as building portfolios.
Great. And so, Ryan, thank you for that nice overview and that estimation of what's to come. But again, interest rates, everyone knows that they're important, but people really don't think how that's impacting on a day-to-day basis. Can you give some examples of how we've worked, how Altfest has worked with physicians, and how interest rates play a role in the decision-making process?
Yes, I think there's a couple good concrete examples for you. One is I was working with a pair of physicians that had an adjustable rate mortgage, or they still hold an adjustable rate mortgage. And just as a quick background for those of you listening, an adjustable rate mortgage has a fixed interest rate over a set period of time, say 5 years or 7 years, just as an example. And then after that set period of time, it subsequently reverts to a variable interest rate that kind of goes up and down with the market. So we have a physician couple that has an adjustable rate mortgage that is set to go into that variable rate period beginning in 2025. And they were wondering whether they should go ahead and refinance into a fixed rate right now because they're concerned about higher interest rates. And we kind of discussed this possibility that interest rates are likely to come down in the future. And they decided to hold off on doing that refinance. They were confident in, hopefully in the next 2 years or more, that they could either refinance into a better fixed rate than they're currently seeing on the market, or maybe they're just going to stick with the variable rate for a period of time and see how things go. But in that case, I think this projection of lower interest rates helped inform their decision. And I would say a second example that applies more broadly is that, we work with a number of physicians that are investing not only in the stock market, but the bond market, and maybe are approaching retirement as an example. And the fact that interest rates are higher now is an opportunity to hold bonds at a more attractive yield. And there are instances, for example, with treasury bonds, where we can kind of lock in that higher yield for a longer period of time, which we think is beneficial for a number of reasons, but for many physicians can make good sense to take advantage of those higher yields.
Excellent, excellent. Thank you very much for showing those two examples of how we're helping physicians navigate this interest rate environment. Moving on, we've talked about interest rates, we've talked about inflation, but can you give us a little bit of an overview of how some of the other key economic metrics are looking as a prognosis for going forward?
I think overall, like you said, we talked about interest rates and inflation, and both are kind of in a so-so or maybe even slightly negative standpoint for the economy in general. Higher interest rates and higher inflation, all else equal, are probably not the best for the economy. But thankfully, both hopefully in the future are showing signs of improvement. On other parts of the economy, we do see some strong things in the economy. One is on the growth front. The recent growth figures were a little bit above what people expected, and actually, meaningfully positive, which is good, a good indicator that we might not be heading into a recession right away. Also, the labor market, especially, I speak to physicians and other types of doctors that run their own practice. I think the labor market has been a tricky part of the economy, and overall, a strong jobs market is actually probably a good thing for the economy. So that's one bright spot. On top of that, most corporations are actually seeing profits hold pretty steady despite that strong labor market, and despite the fact they're having to pay employees a lot more money. So that's yet another positive. All that said, there are some risks to the overall economy, including the fact that we might see less lending out there, partly due to higher interest rates, partly due to other factors. So there are some concerns that could affect the economy. But overall, I'd say, when you kind of combine these all up, there actually are opportunities out there when it comes to investing in this higher rate environment. And, I think as an investor, you shouldn't be scared off by some of these factors that are somewhat negative right now in the economy.
Excellent. Thank you very much. Moving a little away from the macroeconomic factors to talking a little bit about investments and markets right now. How would you say the stock market is right now? Would you say it's reasonably priced, or how are valuations in general?
Overall, it looks like the market is slightly above average on the price front. So it's a little bit more expensive than average. And that's really on a number of metrics. I think price to earnings ratio is a key one. And that's what this chart I'm sharing is showing, that the price to earnings ratio is trading a little bit above the 25-year average. And many other valuation market metrics also show that the stock market is a little bit expensive here in the US, as represented by the S&P 500 in this case. So that is something we're taking into account when we're building portfolios and considering what portion to allocate to US stocks.
Excellent. And then what about how US stock valuations are compared to international stock valuations?
Yes, and I think this chart does a great job at addressing that question. Overall, international stocks are cheap relative to US stocks. Historically, they've always traded at some level of discount. We can see here on this chart over the past, let's just say since 2003, over the past 20 years, international stocks have traded at a close to 15% discount to US stocks. Right now, they're trading at much closer to a 30% discount. So for anyone that remembers their statistics class from college, that's actually a meaningful difference in that it's 2 standard deviations away from the average. So we are in a, let's call it 97, 98th percentile when it comes to cheapness. Very unusual relative to history. And, we think international stocks represent good value at the moment relative to their US peers.
Excellent, excellent. That's good food for thought. Very good food for thought. And then last question for today's video. I know that there was a lot of consternation a couple of months back when a couple of significant banks failed in the US economy. Do we think that the bank failures that happened earlier this year are going to affect the economy and the markets in any meaningful way going forward?
It's interesting, because I think the stock market in general has moved past those bank failures and maybe aren't incorporating a lot of expectation of negative impacts from those bank failures at this point. Our firm, on the other hand, in many ways, I think thinks contrarian and tries to, pay attention to details that others might not be paying attention to. And, we think the bank failures could lead to tighter lending standards, more capital required that banks hold on hand, especially those smaller and mid-sized banks that were kind of the culprits to a lot of these issues this year. So we think there could be a trickle effect of less lending, less capital available to small and mid-sized businesses that isn't fully appreciated at the moment. So it is something we're carefully watching and thinking about when we're building portfolios.
Excellent, excellent. Well, thank you very much, Ryan, for being with us today on Wealth Matters for Physicians. I think you've given our viewers, our physician viewers, a very good understanding of some of the macroeconomic forces that are currently affecting the economy and the financial markets. So we really appreciate you being here today.
Thank you, Mike.
If you'd like to discuss the information explained in today's video, receive a complimentary review of your investment portfolio, or a retirement readiness analysis, or discuss any other personal financial planning area with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732, or by emailing Jesse at his email address, which is also in the description of today's video. If you like today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them optimize their finances. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, We'd love to hear from you. So please give us your comments in the comments section below. Well, that's all for today, physicians. Thank you very much for watching today's video, and I look forward to being with you again in our next one. Until then, be well, and remember to keep on optimizing your finances, or let us help you if you'd like.